The most powerful invention in human history wasn't the wheel or fire, but an abstract concept that allowed us to transcend immediate needs: money. Its origins are far more complex and fascinating than simple barter, emerging from the very fabric of early human societies. This deep dive into financial history explained, when money was invented, unearths the millennia-long journey from primitive exchange to sophisticated monetary systems. It's a story woven with the threads of trust, social agreement, and the relentless human drive to organize and optimize interaction. Understanding how money came to be is to understand the very foundations of civilization, commerce, and power. Beyond barter, the myth and the reality of early exchange. Imagine a world without money. How would you get food, shelter, or tools? The common answer that immediately springs to mind is barter, the direct exchange of goods for goods. However, this simple notion, popularized by economists like Adam Smith, masks a far more intricate truth about early human exchange. Smith's The Wealth of Nations famously posited barter as the natural precursor to money, driven by a fundamental human propensity to truck, barter, and exchange. Yet anthropological and historical evidence suggests that widespread, systematic barter was rarely the primary mode of exchange in most pre-monetary societies.
The fundamental problem with pure barter is the double coincidence of wants. For an exchange to occur, both parties must not only possess something the other desires, but they must also want it at the same time, in the right quantity, and often at the right quality. If a farmer has surplus grain but needs a new tool, they must find a tool maker who, at that precise moment, needs grain. If the tool maker already has enough grain, no exchange can take place, no matter how much the farmer needs the tool. This inherent inefficiency severely limits specialization, large-scale trade, and the division of labor that are hallmarks of more complex societies. Instead of widespread barter, early human societies, typically small kinship-based communities, often relied on gift exchange and reciprocity. In these economies, social bonds were paramount. Exchange was driven more by social obligations, strengthening relationships, and establishing status rather than immediate, calculated quid pro quo. Examples abound, from the elaborate Kula ring exchange system among the Trobriand Islanders, where ceremonial shell necklaces and armbands were traded across islands to solidify alliances, to the potlatch ceremonies of Pacific Northwest indigenous peoples, where lavish gifts were distributed to demonstrate wealth and status. These were not direct barters, but systems of delayed reciprocity, where favors were remembered and returned over time, building social capital and reducing the immediate need for a double coincidence in every transaction. One gave, expecting a return, but not necessarily immediately or in kind.
Alongside gift economies, the concept of credit and debt existed long before standardized currency. In these tightly knit communities, promises to deliver goods or services in the future, based on mutual trust and social reputation, were common. Early forms of accounting, often simple tally sticks or marks on clay tablets, were used to track these debts and obligations, even without a universal medium of exchange. One might owe a neighbor a day's labor or a portion of a future harvest. As societies grew larger and interactions moved beyond immediate kin, the need for a more impersonal and standardized medium of exchange became apparent. This led to the emergence of what we might call proto-money, or commodity money candidates. These were goods chosen for their intrinsic desirability and practical characteristics. Salt, essential for food preservation and diet, especially for herdsmen, served as a valuable commodity in many regions. Cattle, or pecus, from which the Latin word for money, pecunia, derives, were durable, reproductive, and mobile, but not easily divisible, and their value fluctuated. Grain or other agricultural produce were stable goods, but perishable and difficult to store or transport over long distances. Shells, particularly cowrie shells, were durable, portable, difficult to counterfeit, and thus used as currency in various parts of Africa and Asia. Even tools and weapons held inherent value for their utility, but their diverse forms made standardization challenging. Metals like copper, silver, and gold were valued for their scarcity, beauty, and malleability, even before they were minted into coins.
The crucial shift was the move from simply using valuable goods to selecting certain commodities as standardized units of value. These goods possessed a quality known as fungibility, the ability for units of a commodity to be interchangeable. When a commodity began to serve as a common denominator for valuing other goods, even if not always used directly in every transaction, that was the true, crucial step away from pure barter. It was the moment a commodity transcended its utility to become a measure of value, laying the groundwork for abstract money. The cradle of civilization, Mesopotamia, and the first abstract money. In the Fertile Crescent, often hailed as the cradle of civilization, the birthplace of cities and empires, a remarkably sophisticated form of money emerged. This currency defied physical presence, operating as an abstract system of credit and debt, far in advance of coined money. The Sumerian Revolution, characterized by vast agricultural surpluses, enabled the growth of complex urban centers and specialized labor. This surplus, however, needed to be managed. Temples and palaces became the central economic hubs, functioning as massive storage facilities for grain, oil, textiles, and other commodities. They essentially acted as proto-banks, holding communal wealth and redistributing it to priests, soldiers, artisans, and laborers. Managing these vast surpluses and their distribution required highly sophisticated record-keeping and accounting systems.
This meticulous accounting led to barley becoming the earliest standard unit of account in Mesopotamia, particularly in cities like Uruk. As a staple crop, barley was vital for sustenance and consistently produced. Standardized measures of barley, such as the sela, allowed for precise valuation of goods and services. Crucially, while barley possessed intrinsic value, most large-scale transactions were recorded on clay tablets rather than involving the physical movement of tons of grain. This was a system of abstract representation. As trade expanded beyond local communities, the advantages of a more compact and durable standard became apparent, leading to the rise of silver as a secondary, universal standard. The shekel, originally a unit of weight, not a coin, came to represent approximately 8.3 grams of silver. It became the primary unit of account for larger transactions, especially in foreign trade, where barley was impractical. Silver was traded in unminted forms, such as ingots, rings, or pieces of scrap metal. For each transaction, the silver would be cut and weighed, a cumbersome process prone to fraud through debasement or clipping. The true innovation of Mesopotamian finance, however, was the widespread use of debt and credit recorded on clay tablets. Thousands of cuneiform tablets document complex debt contracts, loans at interest, commercial agreements, and even marriage contracts that included financial provisions. Temples and palaces regularly loaned out barley or silver to farmers, merchants, or for public works, expecting repayment with interest. Private individuals also engaged in extensive lending. The power of these abstract financial obligations was profound. Debt slavery was a harsh, common consequence for those unable to repay.
The sophistication of this system demanded early legal frameworks. The Code of Hammurabi, one of the earliest and most complete written legal codes, contained detailed laws governing interest rates, debt cancellation, agricultural loans, and commercial transactions. The state actively intervened to regulate markets and protect debtors, sometimes through periodic debt jubilees that canceled certain debts to prevent widespread social unrest. Ultimately, the nature of Mesopotamian money was profoundly abstract. They understood money not merely as a physical medium, but as a unit of account,
an abstract measure of value. Their economy operated largely on a credit-based system, where recorded debt and promises of future payment, rather than constant physical exchange of commodities, facilitated commerce. This was a sophisticated fiduciary money system, relying on trust and robust record-keeping, millennia before the invention of coins. It demonstrated that money, in its essence, is fundamentally a social technology, a system of accounting for obligations and value, rather than merely a tangible object. The invention of coinage, Lydia, and the standardization of value. For millennia, precious metals had been recognized as valuable and had served as proto-money, but their use was cumbersome. Gold, silver, and copper were traded by weight, requiring constant weighing and purity testing at every transaction. The final step, the true invention of money as we commonly understand it, was to standardize and certify that metal, forever changing commerce, warfare, and state power.
The problems with unworked metal were numerous. Every transaction demanded scales, adding time and the need for trust in the accuracy of weights. Purity was a constant concern. Metals could be adulterated or debased by adding cheaper alloys, necessitating skilled assayers to verify their content. Fraudulent practices like clipping or shaving, reducing the metal content from the edges of ingots, were common. Furthermore, the lack of uniformity in shape and size made large-scale and rapid trade highly inefficient. The solution emerged in the Lydian kingdom, an ancient civilization located in western Anatolia, modern-day Turkey. This region was rich in electrum, a naturally occurring alloy of gold and silver found in riverbeds, particularly the Pactolus River. Electrum's natural presence and intrinsic value made it an ideal candidate for early monetary experimentation. It was in Lydia around the 7th century BCE that the first true coins were issued. Credit is generally given to King Alliantus or possibly his predecessor Gyges. These early coins were small, bean-shaped lumps of electrum, often irregular in form, but critically, they bore an official stamp. This stamp, typically an emblem like a lion's head, was a guarantee from the issuing authority, the king. It certified the precise weight and purity of the metal within that lump, eliminating the need for tedious weighing and assaying at each transaction. This was a monumental innovation. The stamp instilled trust in the coin's value, backed by the authority of the state.
Coinage quickly spread from Lydia across the Aegean to the Greek city-states and eventually the vast Persian Empire. The Lydian king Croesus, famed for his immense wealth, perfected the system, separating gold and silver issues to create a sophisticated bimetallic standard. The Greek city-states rapidly adopted coinage, recognizing its immense advantages for local trade, paying soldiers, and asserting civic pride. Each city minted its own distinctive coins, like the iconic Owl of Athens or the Pegasus of Corinth. The Persian Empire, under Darius the Great, introduced its own influential gold daric and silver siglos, which circulated across its vast domain. The advantages of coinage were transformative: portability and divisibility. Coins were easy to carry and came in various denominations, making them suitable for both large and small everyday transactions. Fungibility. Standardized units meant that all coins of the same type and denomination were interchangeable, simplifying commerce. Reduced transaction costs. The elimination of weighing and testing significantly sped up trade and economic activity. State control. Coinage gave governments unprecedented tools for managing the money supply, collecting seigniorage, the profit made from minting coins, and even for propaganda by featuring rulers' effigies or state symbols. Military pay. Coins were exceptionally efficient for paying mercenary armies and professional soldiers, enabling sustained military campaigns far from a state's treasury.
The invention of coinage marked the birth of practical monetary economics.
States quickly learned that the value of coinage was subject to its supply and demand. They also discovered the dangerous temptation of debasement, reducing the precious metal content of coins, for example by aiding cheaper base metals, to increase the money supply and finance wars or lavish projects. This inevitably led to inflation, eroding public trust in the currency. Early financial institutions such as money changers and lenders emerged to handle the complexities of different currencies and facilitate trade. The coinage revolution was not just about better money, it was about empowering states and expanding human interaction. It facilitated long-distance and large-scale trade, supported the growth of cities by enabling more specialized labor and complex markets, and gave governments unprecedented tools for taxation, military funding, and economic management. Coinage was not merely a medium of exchange, it was an instrument of power that reshaped the ancient world. Rome, the master of imperial currency. From a fledgling republic battling for control of Italy to a vast empire spanning continents, Rome mastered currency not just as a medium of exchange, but as a strategic tool for conquest, administration, and maintaining imperial power.
Rome's early monetary system was primitive, reflecting its agrarian, local economy. It relied initially on as rude, unworked lumps of bronze traded by weight. Later came as signatum, larger stamped bronze ingots, followed by as grave, heavy cast bronze coins. These as grave were cumbersome, impractical for daily transactions, and primarily used for large payments like fines or major purchases. This system was localized and inefficient for a burgeoning power with growing external ambitions. The true transformation began in the 3rd century BCE, driven by increased contact with the monetized Greek cities of southern Italy, Magna Graecia, and the escalating demands of the Punic Wars. Rome desperately needed a more versatile and internationally recognized currency. This led to the introduction of silver coinage, specifically the denarius. Initially valued at 10 asses, bronze coins, and later 16, the denarius became the backbone of the Roman economy, a coin that would dominate the Mediterranean for centuries. Much later, the aureus, a gold coin, was introduced primarily for very large transactions, imperial prestige, and high-value military payments. Roman monetary policy became intrinsically linked to its imperial expansion. The denarius was crucial for military pay, enabling Rome to field vast professional armies far from home for extended campaigns. This facilitated conquest and the projection of Roman power. Newly conquered provinces paid taxes in Roman coinage, ensuring its widespread circulation and demand across the empire. Furthermore, the spoils of war were not just fleeting gains. Vast amounts of precious metals, particularly silver, from the Spanish mines acquired after the Punic Wars, were melted down and minted into new coinage. This provided a continuous influx of capital that funded further expansion, creating a self-reinforcing cycle of conquest and monetary supply.
However, the immense demands of empire, particularly financing wars and the increasingly extravagant spending of emperors, led to a dangerous practice: debasement and inflation. Emperors frequently resorted to reducing the silver content of the denarius and later the antoninianus to create more coins from existing metal reserves. This process involved clipping existing coins, or, more commonly, adding cheaper base metals like copper or tin to the silver alloy during minting. The consequences were devastating. Public trust in the currency rapidly eroded. People began to hoard older, purer coins and only spent the new, debased ones. This led to rampant inflation, as goods and services required ever-increasing numbers of the debased coins. Economic instability became endemic. The crisis of the 3rd century CE, a period of intense political instability with frequent changes in emperors, coincided with extreme debasement, leading to hyperinflation and a near collapse of the monetary economy. In an attempt to stabilize the collapsing system, Emperor Diocletian implemented significant reforms in the late 3rd century CE. He introduced new, more reliable gold and silver coins, such as the argentius and pholus, alongside a reformed bronze nunmux. He also famously issued the Edict on Maximum Prices, an attempt to control rampant inflation by state decree. This edict largely failed, however, as it was widely ignored, leading to black markets and shortages. As trust in currency further eroded, the economy increasingly reverted to a system of payment in kind. Soldiers and officials were paid in food, clothing, or land rather than cash, marking a partial return to a pre-monetary form of economy.
The legacy of Roman currency is profound. The denarius, through its consistent use and vast circulation, became a widely accepted international currency for centuries. Rome's history also powerfully demonstrated both the immense power and the inherent dangers of a state's ability to control its currency. The inability to maintain a stable, credible currency was a significant contributing factor to the economic weakening and eventual decline of the Western Roman Empire. The story of Roman money is a powerful illustration of the unbreakable link between sound finance and imperial stability. Beyond metal, paper money, banks, and the age of abstraction. From the reassuring solidity of metal, money took its boldest leap, yet again into pure abstraction, the promise embodied on a piece of paper. This transition, beginning in the East and later perfected in the West, ushered in the age of modern banking and national currencies. The earliest forms of paper money emerged in China during the Tang and Song dynasties, well over 1,000 years before their widespread adoption in Europe. Merchants, weary of carrying heavy metal coins over long distances and risking banditry, began using flying cash, or fei qian, promissory notes issued by shops or government offices. Later, the government itself issued the first true paper currency, known as jiaozi, and later huizi. Initially, these were convertible to metal, but eventually they became fiat currency, deriving value purely from government decree and public trust. The invention was driven by a shortage of copper coins, the sheer convenience for large transactions in a vast empire, and the government's fiscal needs, particularly for financing wars. While revolutionizing trade, China's early experience also provided early lessons in the dangers of hyperinflation when governments overissued paper money. In the West, the evolution was more gradual, beginning with goldsmiths, bills of exchange, and proto-banks in medieval Europe. Merchants across long distances used bills of exchange to settle debts without physically transporting gold or silver, mitigating the risks of theft. These were essentially written orders to pay a specific sum to a specific person at a future date. Simultaneously, goldsmiths, who held gold for safekeeping for their clients, issued receipts. These receipts, easily transferable, soon became a de facto form of paper money, accepted in payment without the need to redeem the underlying gold each time. This practice led directly to the birth of fractional reserve banking. Goldsmiths realized that not all clients would demand their gold back at once. They could safely lend out a portion of the gold deposited, effectively creating new money in the form of loans out of thin air, backed by only a fraction of their total reserves. This innovation, while immensely powerful for stimulating economic activity, also introduced systemic risk.
The idea of government-issued paper currency gradually took hold in the West. The Bank of England, founded in 1694, became the first central bank to issue widely accepted banknotes, initially convertible to a fixed amount of gold. In the North American colonies, colonial scrip was issued, paper money not backed by metal, relying purely on the promise of the colonial government. This was an early experiment with pure fiat money in the West. The Napoleonic Wars across Europe in the late 18th and early 19th centuries further accelerated the use of paper money, as nations issued vast amounts to finance their conflicts, often leading to significant inflation. The 19th and early 20th centuries saw the rise and dominance of the gold standard. Most major economies formally pegged their currency directly to a fixed weight of gold. This system provided an anchor for currency value, limiting a government's ability to print money freely and fostering stability and trust in international trade. However, it also constrained economic growth, made managing economic crises difficult, and was susceptible to fluctuations caused by gold discoveries or shortages. The gold standard eventually broke down under the strains of two world wars and the Great Depression. The post-World War II Bretton Woods system established the U.S. dollar as the world's primary reserve currency, indirectly linked to gold, with other currencies pegged to the dollar. This system, however, ended with the Nixon shock in 1971, when the U.S. unilaterally abandoned the gold convertibility of the dollar. This moment ushered in the era of pure fiat money for virtually all major currencies. Fiat money is not backed by any physical commodity. Its value derives solely from government decree, fiat, and the collective trust of the public. Its advantages include allowing central banks flexibility to manage the money supply to stabilize the economy and enabling governments to finance spending more easily. The disadvantage is the inherent risk of inflation through excessive money printing and the potential for a complete loss of value if public trust erodes.
Today, in the digital age, most money exists only as electronic entries in bank ledgers, flowing across networks at unimaginable speeds. The latest evolution, with cryptocurrencies and central bank digital currencies, pushes money into entirely new forms and raises fundamental questions about trust, control, and the very nature of value itself. The invention of money was not a single event, but a continuous journey of human ingenuity, evolving social consensus, and the relentless drive to organize and optimize interaction. From the abstract accounting of Mesopotamian barley to the standardized metal of Lydia. From the paper promises of China to the digital code of today, money has always been a reflection of how societies organize, trade, and ultimately survive. It is a story of evolving trust, shifting power, and the enduring human need for a universal measure of value. The journey continues, now at an unprecedented pace.